Imagine waking up tomorrow and discovering that the AI boom everyone thought was being powered by innovation is actually being supported by $1.65 trillion in hidden debt and future financial commitments. Not government debt and not one giant loan sitting inside a single company. This is the kind of debt and obligation buried inside data center leases, infrastructure agreements, financing structures, and long-term commitments that allow the biggest technology companies on Earth to build AI infrastructure at an almost unbelievable speed. Microsoft, Amazon, Google, Meta, and Oracle are all spending enormous amounts of money chasing the same thing. More chips, more servers, more data centers, and more electricity. From the outside, it looks like the greatest technology boom in history. But underneath that boom is a question that almost nobody wants to ask. What happens if the money being spent today doesn't generate the enormous profits everyone is expecting tomorrow? The AI revolution is very real. The technology works, people are using it, and companies are already making billions from it. But there's a major difference between saying that AI is real and saying that every investment being made around AI will eventually be profitable. And that difference is becoming extremely important. Because the faster AI infrastructure expands, the more money has to be invested, borrowed, committed, or locked into long-term contracts before that infrastructure can ever generate a return. AI doesn't necessarily have to fail for this story to become dangerous. The technology can continue improving, AI adoption can continue growing, and these companies can remain incredibly powerful. And yet, the financial structure underneath the AI boom could still become a problem. To understand why, you first have to look at what is actually happening behind the AI products people see every day. When someone hears the word AI, they usually think about chatbots, image generators, coding assistants, autonomous systems, and other software. But all of that software depends on an enormous physical infrastructure sitting behind it. You need advanced semiconductors, thousands of powerful servers, networking equipment, cooling systems, massive buildings, and above all, enormous amounts of electricity. A modern AI data center isn't simply a warehouse filled with computers. It can require billions of dollars before it produces a single dollar of revenue. That's why the world's biggest technology companies are racing to build AI infrastructure as quickly as possible. Microsoft is expanding its data center footprint. Amazon is pouring money into cloud and AI infrastructure. Google is doing the same. Meta is building massive amounts of computing capacity. Oracle has positioned itself as an increasingly important infrastructure provider for the AI boom. And behind all of these companies is another enormous network of businesses supplying chips, servers, networking equipment, power systems, cooling technology, construction, land, and electricity. The entire ecosystem is expanding at incredible speed. And this creates a powerful feedback loop. AI companies need more computing power, so data center operators build more capacity. Data centers need chips, so semiconductor companies sell more processors. They need electricity, so energy infrastructure expands. They need buildings, so construction companies get more business. Investors see the growth and provide more capital. More capital allows even more infrastructure to be built. And everyone expects future AI demand to justify today's spending. As long as demand keeps increasing, the entire machine looks brilliant. But there's something hiding inside that machine. A huge amount of today's infrastructure spending is based on tomorrow's expected revenue. This is where the $1.65 trillion figure becomes so important. The number represents the enormous scale of future infrastructure commitments connected to the AI and cloud build-out. It doesn't mean that one company has borrowed $1.65 trillion and is about to collapse. The reality is much more complicated. Companies can sign long-term leases, infrastructure agreements, power contracts, financing arrangements, and other commitments that create obligations stretching years into the future. Some of these commitments may not immediately look like traditional debt sitting on a company's balance sheet, but economically, they still represent money that someone has committed to spend in the future. That's why the word hidden is so powerful. The information isn't necessarily secret. Much of it can be found in financial statements, filings, contracts, and corporate disclosures. The problem is that ordinary investors don't always connect all of those individual pieces together. One lease doesn't look dangerous. One data center contract doesn't look dangerous. One financing agreement doesn't look dangerous. But when you combine thousands of commitments across dozens of companies, the total scale becomes enormous. And that's what makes the current AI boom so unusual. The industry isn't simply developing software. It's building an entirely new physical infrastructure layer for the global economy, and infrastructure requires an enormous amount of financing. Now imagine a company spending billions of dollars to build a new data center. The company expects AI customers to use that capacity for many years, so it signs long-term contracts and invests heavily in the facility. Investors look at those contracts and see predictable future cash flow. That makes financing easier. More financing means more construction. More construction creates more AI capacity. More capacity makes it easier to sell AI services. Rising AI revenue makes investors even more confident, and that confidence encourages even more investment. The cycle feeds itself. But there's a dangerous side to that cycle. What happens if demand grows more slowly than expected? The data center doesn't disappear. The building still exists. The servers still have to be paid for. The leases don't disappear. Electricity contracts don't disappear. Maintenance doesn't disappear. Debt payments don't disappear. But the expected revenue may not arrive quickly enough. Suddenly, infrastructure that looked incredibly valuable can become a financial burden. This is why leverage changes everything. If a company invests its own money and the project fails, it loses its investment. But if the company borrows money or signs long-term financial commitments, it still has to make those payments even if the project doesn't perform as expected. That's the fundamental difference between an investment and a leveraged investment. Debt can make a successful project much more profitable, but it can also make a disappointing project much more painful. And this is where the comparison with 2008 becomes interesting. AI is obviously not housing. AI chips aren't subprime mortgages. ChatGPT isn't a mortgage-backed security, and there's no reason to assume the next financial crisis would look exactly like the housing crash. But there is one lesson from 2008 that still matters enormously. The biggest financial risks often appear when everyone assumes that the future will behave like the recent past. Before the housing crash, home prices had risen for years. That made higher prices feel normal. Banks became more comfortable lending. Investors became more comfortable buying mortgage-related securities. Developers built more homes. Consumers borrowed more money. And because the system had worked for so long, people assumed it would continue working. Then housing prices stopped rising. Once that happened, the assumptions supporting the entire financial structure started breaking apart. The lesson wasn't simply that houses were risky. The deeper lesson was that leverage can turn a slowdown into something much bigger. When an industry is heavily financed and expectations are extremely high, even a moderate disappointment can create enormous pressure. And that's exactly why investors are watching the AI infrastructure boom so closely. Imagine AI adoption continues growing, but not as quickly as Wall Street expects. Companies still use AI. Consumers still use AI. Models keep getting better. AI remains one of the most important technologies in the world. But revenue doesn't explode at the speed investors expected. Meanwhile, data centers keep coming online. Expensive chips have already been purchased. Long-term contracts have already been signed. Billions of dollars have already been invested or committed. Suddenly, companies can find themselves with an infrastructure problem. They built capacity for a future that hasn't arrived yet. That doesn't automatically mean bankruptcy. Could simply mean lower returns. But lower returns can still cause a major market repricing because today's AI valuations often depend on expectations of enormous future growth. If those expectations fall, stock prices can fall even while the companies remain profitable. And when stock prices fall, raising new capital becomes harder. When raising capital becomes harder, expansion slows. When expansion slows, demand for chips and data center construction can decline. Suppliers feel the pressure. Investors start questioning other companies. And suddenly, what started as a small adjustment in expectations can spread through the ecosystem. That's how financial contagion can develop. There's another issue that makes the AI story even more complicated. The increasingly interconnected nature of the AI economy. One company provides financing or investment. Another company builds infrastructure. A third company supplies chips. A fourth company rents computing capacity. Another company develops AI models that use that capacity. Everyone becomes a customer, supplier, investor, or partner of someone else. None of this automatically means something is wrong. Large technology ecosystems naturally create complicated relationships. But complexity makes financial risk much harder to see. Imagine 10 companies making enormous investments that are connected to one another. Each individual transaction might make perfect sense. But when you look at the entire system, you may discover that the same expected future demand is supporting multiple layers of investment. That's when analysts start asking a much more important question. How much genuine end-user demand is underneath the entire structure? If businesses and consumers ultimately generate enough revenue to support all this infrastructure, then the system can work. But if companies are mostly investing because they believe someone else will eventually create the demand, the cycle can become fragile. That's the fundamental difference between productive investment and speculative investment. Productive investment eventually produces cash flow. Speculative investment depends heavily on the next person being willing to pay more. This brings us to the most important question in the entire story. Who ultimately pays for all of this infrastructure? The answer has to be the customers. Not investors, not banks, not chip manufacturers, and not the companies building the data centers. Eventually, the AI ecosystem has to generate enough real economic value that customers are willing to spend enough money to cover the enormous cost of creating and operating this infrastructure. That's the real test for AI. Businesses clearly want AI, but wanting AI isn't the same thing as paying enormous amounts of money for it. companies have to prove that AI actually increases productivity, creates new revenue, reduces costs, replaces expensive processes, or creates products that customers are willing to pay for. If that happens, today's infrastructure spending could look incredibly cheap in hindsight. But if AI produces less economic value than expected, the industry could discover that it built too much capacity too quickly. And here's the part that makes this story different from a simple prediction that AI will crash. The AI bubble can survive. In fact, it may survive for a very long time. AI doesn't need to collapse. It simply needs to keep producing enough growth to justify the enormous amount of capital being invested. If AI revenue continues increasing, investors can continue financing infrastructure. If productivity improves, businesses can justify more spending. If AI becomes cheaper and more useful, adoption can accelerate. And if AI creates entirely new industries, today's infrastructure could become the foundation for enormous future profits. In that scenario, the $1.65 trillion commitment isn't necessarily a disaster. It becomes an investment in the next generation of computing. And that's the central debate. The same number can represent either massive productive investment or massive financial overreach, depending on what happens next. The number itself doesn't tell us which outcome will happen. It tells us how large the bet has become. So what would actually break the system? Investors shouldn't simply watch headlines saying AI is a bubble. They shouldn't focus only on one company's stock price, and they shouldn't judge the entire industry based on whether the latest AI model looks impressive. The real warning signs would be financial. Watch capital expenditure. Watch free cash flow. Watch debt. Watch data center utilization. Watch AI revenue growth. Watch how quickly companies are signing new infrastructure commitments. And most importantly, watch the gap between AI spending and AI-generated cash flow. If spending keeps accelerating while returns remain uncertain, pressure increases. Because eventually investors will ask a very simple question. When does all this spending actually pay for itself? That question could determine whether today's AI boom becomes a historic economic transformation or one of the largest capital allocation mistakes of the modern era. There is one more factor that could make this entire story even more important, and that's interest rates. When money is cheap, long-term infrastructure projects become easier to finance. Investors are more willing to accept returns that arrive years into the future. But when money becomes expensive, the calculation changes. Future profits become less valuable, borrowing becomes more expensive, and projects that looked incredibly attractive at low interest rates can suddenly look much less attractive. This matters because AI infrastructure is fundamentally a long-term bet. Companies are spending enormous amounts of money today for returns that may arrive years from now. That works beautifully when investors are willing to pay a premium for future growth. But if the financial environment changes, the entire equation can change with it. And that's another reason the $1.65 trillion figure matters. Not because $1.65 trillion automatically means a crash is coming, but because it shows just how large the financial commitment behind the AI revolution has become. So are we looking at another 2008? Probably not in exactly the same form. History rarely repeats itself perfectly, but the underlying lesson remains relevant. When an industry grows faster than its financial foundation can comfortably support, the difference between a revolution and a bubble can become surprisingly small. AI is real. The technology is real. The demand is real. The productivity gains could be enormous. But none of that guarantees that every AI investment will be profitable. And that's the distinction investors need to understand. The AI revolution may ultimately create trillions of dollars in economic value. But to get there, companies are making one of the largest infrastructure bets the world has ever seen. And somewhere underneath that bet sits an enormous mountain of commitments, financing, leases, contracts, and expectations. The $1.65 trillion isn't necessarily the bomb. It's the size of the bet. And now the entire market is waiting to find out whether the future of AI will generate enough cash to justify it. Because if it does, today's spending may eventually look like genius. The companies that invested first could own the infrastructure of the next technological era. The data centers being built today could power an economy that looks completely different 10 years from now. The debt and commitments that appear frightening today could simply become the financing mechanism that helped create one of the most profitable industries in history. But if growth slows before the money arrives, the story changes completely. The same infrastructure that powered the AI boom could become a burden. The same long-term commitments that once looked like proof of future demand could become liabilities. And the same investors who were celebrating unlimited AI growth could suddenly start asking a much darker question. What if we built too much, too fast, with money that was never guaranteed to come back? That is the real risk hiding behind the AI boom. Not that artificial intelligence suddenly stops working, but that expectations, spending, debt, and future cash flows stop matching each other. And if that gap becomes large enough, the market may discover that the most important thing about the AI bubble was never the technology itself. It was the enormous financial machine built underneath it. The AI revolution may be real, But $1.65 trillion is a very big bet on what happens next.